Okay, we're going to start today with the S&P 500. First of all, let's look at the chart for the S&P 500. We see that we're in a downtrend. Lower highs, lower lows. And we're at a very important place right now. We have support going back to June of this year. June 17th was the low, and it looks like we're hitting that today. So we're actually at support in the S&P going back for, this is called a double bottom. Whenever you go down and you retest that bottom. And if we hold at this bottom, there's a very good chance that we could have a short-term bounce. Some people call it a dead cat bounce, and some people call it support for a move up in the market. You can see that we're oversold, probably to the max. Jim Cramer says we're -7 on the S&P oscillator. That is one of the lowest oversold ratings. So whenever things are oversold in the stock market, it's an indication to buy. So let's look at the actual S&P 500. You can see in the chart, this is 6/17/2022. So this is we've been calling that the bottom for this year, and if you go back couple years, you'll see we had a pandemic low of 222 way back in March 23rd, 2020. And whenever the stock market starts selling off, you have to look at past levels of support to really understand where there could be a bounce. As a long-term investor, you have to treat situations where the stock market is going down as wasted dollar cost into positions. And Jim Cramer would say, you got to nibble and watch. So, for instance, in the pandemic, we knew that things were really bad in the news. Stocks were going down exponentially every day. Limit down, limit down, limit down. What do you do? And in such a situation, you got to pick your points. Pick the stocks that you think are high quality. They're going to be around in 5-10 years that are still growing. And you have to buy a little bit at a time if you're not invested. If you are invested, you have to look at the big picture, which is the S&P maximum. And that is, the major crashes in the world that we've had. This is 2008. It's just a little blip in the radar. And, we've made higher highs after that. So, whenever we look at our meeting notes here, we've been looking at this chart for over a year and a half. Whenever they started talking about tightening, meaning the Fed is increasing interest rates and reducing the amount of money in the system, we look at the big chart, which is whenever there's money coming into the system, whenever the Fed prints money, the stock market goes up. And whenever the Fed starts reducing the stimulus, the stock market goes down. So that's just a fact what we're going to have to deal with right now. So the Fed's balance sheet, whenever it goes down, QE normalizing, which is taking money out of the system, we correct. And so for us as long-term investors, we have to just see that in the next year, maybe year and a half, we're going to be in a tightening phase. We're going to be reducing the amount of money available for corporations to operate. That'll make the growth less in the country. So, but in 2 years, we will be in a situation again where we're lowering interest rates, and then that'll goose the stock market up. So, so that's just the big picture we gotta consider. But right now, you can see we're in a situation where we have support going back to June. If we break below this June 17th double bottom low, which is where we're at right now in the S&P, there's a very good chance that we could just free fall like we did in the pandemic times. This is the pandemic, and it doesn't really affect the value of the stocks that we're watching. It just makes them less expensive. Okay, so all right, so that was a good thing to go over. Okay, let's look at the calendar. The calendar, we have the Fed met Tuesday of this week, and we thought it could earlier this month. We were thinking they could have made a statement that they were done with their raising of rates. If that happened, the market would rally. But they signaled that they're going to be very aggressive and they're going to raise more. And the important thing to keep in mind is the Fed tracks the 2-year. So we're going to start watching the 2-year from now on, because the 2-year, as the 2-year goes up, look at this right here. The 2-year has gone from beginning of this year, 0.67. Yes, 0.67 to 4. And if this stops going up, the stock market will, the Fed will they will not raise rates anymore. But if this continues to go up, the stock market will go down. That's because the Fed raises rates in lockstep with the 2-year. So I'm going to start following that 2-year in our notes, because let's see, 2-year, let's look at our notes. There it is right here. So the 10-year Treasury is up 8% this week, and I'm going to start tracking the 2-year, and it's up 6% this week. And if next week we see the 10-year and the 2-year up again the same amount, the stock market's going to be down the same amount, because that's indicating that the Fed is taking money out of the system, making it harder for the companies to grow, and it'll make it harder for homeowners to finance new housing. Housing is a big portion of the GDP. Spending on your house, mortgages, Home Depot, fixing up your house. So right now we have this formula: rates going up, good for banks, bad for stock market, and bad for growth stocks. And this is by itself could be a reason why we're going down in the stock market this week. So we'll keep our eye on this 2-year yield, and if it goes up, that's pretty bad news. Another thing we're going to look at right now is the price of oil. Price of oil is going down. There was an appearance by let me see, hold on. There was an appearance by Jeffrey Gundlach he's considered the bond king. And he said basically that there's a 75% chance of there being a recession. Hold on for 1 second. And because of because of that, there's going to be, it's because of what the Fed said in the notes. Okay, so we have in our meeting notes, Fed was meeting Tuesday of this week. And the Fed said that they're going to raise more after this 75-point hike. And because of that, that's going to restrict economic activity in America, and that's going to lead to a recession. If in the depth of the recession is based on how the Fed raises more and more and more. So the reason why we're concerned about all these interest rates and things is because it affects the stock market. Every stock follows the S&P. And as the S&P goes down or goes up, so does 90% of other stocks. So that's why we're so fixated on the S&P, trying to understand where it's going to go next. Okay, hold on. Okay, so now, let's look at some of the top movers for today. Generac is a renewable energy. They do backup energy sources for houses, and they put solar power on houses. A lot of housing things here. Sherwin-Williams paint for houses. You have Equifax. Okay, no real common thread there, but top recliners are definitely oil. Look at all those oil companies. So we talked about before if there is a recession. Now, Jeffrey Gundlach said that there is a 75% chance of there being a recession. If that's true, then the price of oil is going down. Let's look at Jeffrey Gundlach's notes. Hold on. Long King. Jeffrey Gundlach says the Fed's devotion to big rate hikes, they just said on Tuesday, there's a 75% of a U.S. recession next year. Okay, so that means that there's an alternative to the stock market. Last year we were saying the word TINA. There is no alternative. You had an option of buying a bond for less than 1%, or you put your money in the S&P and you get 1.5% plus anything that goes up. So there was no alternative last year. But now, this guy, he's really good. He said that there's excellent opportunities now for fixed income to make 8 to 10% a year safely. That's really important, because now there's money coming out of the stock market going into safer investments. And he said whatever the Fed said this Tuesday is bad for risk investments, which is stocks and equities and options, etc. So this is really important. But the thing to keep in mind if there is a recession, the price of oil will go down, and that's because the lack of demand. If you have less tractors going, you have less tractor trailers, you have less cars running around in a bad economy, an economy that's in a recession, there's a lack of demand for oil. So if you're interested in oil companies, there's a very good chance that this is going to go down to $65 a barrel or less, maybe $50 a barrel in a really bad environment, a really bad economic environment. So if you're invested in oil, all the oil companies will go down with the price of oil, regardless if they're well run or not. So we called this oil, this change in sentiment in oil like a couple months ago. We saw, and let's look at it. XLE. XLE. There it is. Okay, so XLE was on a tear last year. It was making higher highs, higher lows. It was the only sector doing good up until June. Yes, that was this year. And we noticed right here, it fell out of this channel, this long-term up channel, and we saw it going down, making lower highs, lower lows. Now we're back in this uptrend with the XLE. If we go into recession, we're at the bottom of the channel. There's a very good chance the price of oil is going down here. And I mean, the XLE, all energy companies are going to go down because there's lack of demand for energy whenever the economy is not doing so good. So, all right, so we're going to go back to our meeting notes. Okay. Go back to our meeting notes. Okay, so this was a very important, you can go back and listen to this by clicking this link in our meeting notes. Okay, so there's a link. Every meeting, every story that I highlight, there's a link to the story above in the meeting notes. So, all right. So let's go back to what our meeting notes. SP's down since last week. 10-year yield is going up. And the Fed, and there's a saying called "Don't fight the Fed." And the Fed never fights market rates. So as the 2-year goes up, and the interest rates will go up with it. So the 2-year, we already mentioned, is 4.2. If it stays flat, the stock market will settle down. But if it keeps going up, the stock market will go down because the Fed will raise. Now, things that we were waiting for the catalyst to the market to go up. Definitive Fed statements. We were expecting something definitive on Tuesday, and basically the Fed did not help us out. They said they're going to continue to raise, and they hinted that they're going to raise another 75 to 1 point. That is why the stock market sold off. And good earnings announcements, we didn't have that either. Ford warned of input costs, but they retained their forward-looking estimates. So they're going to probably cost cut and try to make their numbers by other means because their input costs are going up. We don't have anything over here. We're waiting for buybacks to happen. We know Google and Apple, the big tech companies, are buying back before the beginning of the year because that's one of the ways they return money to shareholders. And it's going to be taxed at the beginning of the year, 1%, the buybacks. So that could goose the market in the last couple months. We don't have any good news. Supply chain bottlenecks getting better. They're actually still affecting Ford. Ford had a warning about supply chain bottlenecks. So let me see. We still have the 10-year yield going up. Nothing happening in the war really. Ukraine's kind of starting to win the war. So if that progresses, that can make the stock market jump an amazing amount. Maybe 10%, 15%, 20% in a week. So let me see. So we're still looking for companies that are low PE ratios, low PEG ratios, stocks that are conservative, that people will buy in good times and bad. And trash companies, people have trash good times and bad. You have drug stocks in recession, so people are not going to take their medicine. No, they're going to continue to do that. So we're looking for, but as the stock market crashes, if we end up with value stocks that have a PEG ratio less than 1 that are growth stocks, we're going to start looking at those too. So let's look at the big numbers. The numbers, these are variables, major variables, into the S&P and to earnings. Crude, this is oil, it's down 5% this week, and it's down 10% including today's 5% drop. So we said a couple months ago, in a recession, oil will be 65. So Jeffrey Dunlop says 75% chance of a recession next year. There's a chance we're going to be going to 65 to 40 to $50 a barrel in oil. So, and that's just because of a reduction in demand. Low demand, that will cause crude to go down. And 10-year Treasury is up. And we're going to start tracking the 2-year Treasury too. That's up 8%. So, let me see. So we don't have it. We're looking for a trend every month of inflation going down. There are people saying that we see the gas prices going down. We see the commodity prices going down. Why isn't inflation going down? It's currently 8.3%. So there's a guy named Jeremy Siegel. He's like a professor at Harvard. He says that it's pretty nuts that they keep on raising interest rates because all these commodity prices are going down in a major way. And Jeremy Siegel's a little afraid that the Fed's going to raise too much and that'll crash the economy and make the GDP go down lots. Okay, so if we look at our sector ETFs, let's look at what's going up and down today. We know the price of oil is down 5%. We can see the top going down stocks and sectors are energy related. Let me see. Financial, that's surprising because if interest rates go up, we expect the financials to do better. Utilities, okay, the oil, all the oil energy related stocks are down. Gold's down, and materials. And the ones doing the best, believe it or not, are home construction. You would think that if there's interest rates going up, that would make it harder for people to pay their mortgages because the mortgage rates go up. If the total payment for a mortgage goes up with rising interest rates, there's less affordability to buy a house and there'd be less demand. You would figure the home builders would be going down, but they're up the most today for some reason. Maybe a good report from one of the companies. Healthcare. These are all very conservative stocks. They pay dividends. They're consistent demand in good times and bad. Utilities. People aren't going to stop using electric in the middle of a recession, so that's a consistent demand. They pay dividends. Retail, biotech, and real estate. Okay, that's a good understanding of what's going up and down in sectors. Let's go next to look at the S&P. Okay, last week we had we were making lower highs, lower lows in our short-term trend, and we were nearing the bottom of this channel. We knew that we had the June lows, as support, and we had just a little bit of support from the last 2 months. We ended up going down to this June lows support today, and we held. So that's a good indication. If we bounce on Monday, there's a good indication we're going to have a rally of, a really base-ripping rally. But if we go through the support from June, we're in free fall. I don't know where the heck we're going to go. Okay, so I mapped out the what I showed you earlier. This is the pandemic lows. These are levels of support. Whenever you have a free-falling market, like we have right now, we have to look at past levels where there was, where we actually bought on a dip and we went up. And you can see we have at 323 in the S&P, and this is this pandemic lows at 222. So if we go down on Monday and we go down for an extended period of time, we're going to hit this level of support, which held right here and here. And that's just the way you have to look at dollar costing into the market. So in other words, if you have no positions at all, and you know Monday we're starting to go down, limit down, you have to start dollar costing, putting some money in at these major support points. And like right now, we're at a major support point, so you would put a little bit in right now. But Jim Cramer would say you have to nibble a little. The professionals watch and buy a little bit at a time, and they watch the earnings estimates and make sure they're not changing at all. Okay, so Jim Cramer says we have a situation of shrinking PE ratios in stocks. So last year we had stocks that were overvalued. We had crazily valued stocks like DocuSign, and they had PEs of 170, and they were only growing at 20%. So they had so the stocks with PEG ratios of 4 or 5, or not, some without even earnings, they're going down a lot. And the stocks with like Apple and Google that have PEs of 30, and they're getting more reasonable valuations now to closer to their growth rate. So that's what Jim Cramer meant by shrinking P ratios. So if we let's look at Apple, just for the largest company in the U.S. market. And let's look at the statistics for Apple. You can see that its PEG ratio is 2.75. That means it's, right now it's growing. Let's see so its PE is 24. And it should be growing at 24% if its PE is 24, but it's actually growing at like 7% a year. So that means that Apple could, in a really bad market, could trade down. You divide the current price by 2.75. That gives you the price that it's if it's trading at its growth rate. So, but Apple has consistent earnings, and they have a lot of different ways to make money. And the same thing with Google and Microsoft. They have many ways to make money, even in good times and bad. So that makes them a little bit more robust, the company. So they trade at a higher valuation. And they're more reliable, too. Okay, let's go back to our meeting notes. Okay. Jim Cramer is actually saying to buy oil stocks. I think that's pretty bad advice. Because if we have a 75% chance of a recession, the price of oil is going to go down. And if you own any oil stock, it will go down with the price of oil. So if you're over leveraged in oil right now, you have a lot of oil in your portfolio, then it's a good time to start paring back, if indeed these predictions of recession are true. Okay, the S&P, Jim Cramer said the S&P oscillator is at negative 7.04. That is oversold. And Jim Cramer's waiting for the VIX to go above 30. Right now it's around 30. And in this environment, he says, professionals watch and nibble. So you buy, you see the stocks you're interested in, and you just have to buy a little bit at a time. And because if it goes down a lot every day, you gotta in any day that there could be a good news that makes the market go up. So that's why he said watch and nibble. He says when this 2-year treasury stops going up, that will be what makes the market stable again. Okay. So we like to watch this. The U.S. Treasury is up. And the 2-year Treasury, we're going to start keeping track of this. That's up 6% and 8%. So that's really bad. That's in itself, this is a good reason why the stock market would sell off. If we go up again next week, that is bad news for the stock market. Fear and greed index. As of this morning, the fear and greed was 28, but we're going to check it now because it's just in overnight, it's changed from fear to extreme fear. So Warren Buffett says you have to be fearful, greedy when people are fearful, and the opposite, when people are greedy, you have to be fearful. So all these indicators for these are contrary indicators. When people are fearful, that's the time you start nibbling and buying select companies. And one thing is, whenever the people are extremely greedy, you have to start selling some of your positions or don't buy. So people are fearful now. This is becoming like a panic situation. It's becoming worse every week. 3 weeks ago, we were neutral greed. Then we're starting to get the fear. Now we're fear. Now we're extreme fear. And what happens is people get the weak hands of the market, the people that are nervous Nellies that are afraid it's going to go down forever. They start selling out at extreme fear. The market collapses and then it bounces 10% in 2 days. And there's just a pattern. If you're a long-term investor, you have to buy and hold and be willing to go through all these extreme situations, knowing that your company is going to be flat or down a little bit during the recession times, and good companies pick up very quickly and start going again whenever things are back to normal. Okay, so the VIX is 28.5. That's up 6%. So if we look at the VIX, the VIX is another contrary indicator. Whenever the VIX is high, that's a good indication that it's getting closer to time to buy. Whenever it's down to 20, that's an indication that people are more comfortable and they're not afraid. And that's you want to sell or don't buy during that time. All right. And just to look at the S&P again, we're actually at, as of today, we're down at this bottom. We're holding the lows of the June 17th. We're totally oversold in the stochastics. We're down to 7 now in the stochastics. That's almost as low as you can get. -7 on the S&P oscillator. So we mentioned in January of this year that this was going to be a bad month because that's statistically what it always is. Let's look at the month. There it is. So September is traditionally the worst month of the year. So we were expecting a bad month. So until the end of this, it'll be great to be out of this month, that's for sure. October, November, December are traditionally good months. And if you put together, the companies are going to be buying back stock because of the new law that says they're taxed 1% on buybacks after January 1st. That's a good way to goose these stocks going up the last month of the year. And you have pension reallocations. You have all kind of seasonality that we don't know about but have to be done that always makes the last couple months good. So wherever it's sold right now, there's a very good chance that one piece of news that falls into place on our list that we've been watching for a while, one of these, if any of these fall into place, that's a good indication we're getting towards a positive sentiment in the market. Okay, so let's go to. Okay, we already talked about this. Unlimited money printing yields to higher stock prices. Whenever it starts taking the money out, it leads to corrections. We have money coming out in a major way, more than ever now. That's going to lead to, unknown correction. And You just have to be willing to dollar cost, put little bits of money in at a time if we have this super bad correction. Let me see. Let's look at some of the stocks that are in uptrends, stocks that are doing good in this environment. Okay, so we're trying to follow this game plan. Companies that raise prices in an inflationary environment, companies that have profits now, make earnings, not a promise for future. They have low PEG ratios, and you see they have companies with high cash flows and rising margins, meaning they make more, they're more profitable. Yeah, let's see what companies are doing good now. Look at this. Pepsi is still in an uptrend. Is making higher highs, higher lows. They pay a dividend. They say they can raise the prices on their Frito-Lay unit and Pepsi without customers demanding less. So they said they're increasing their prices and they have pricing power. So that's like a perfect stock for this environment. It works really well. They're at the low end of their channel and they're oversold. Okay, Walmart. Whenever we were talking last week about how during recession times, even people with wealthier households, they trade down in a recessionary environment. So during the last recession, Walmart was one of the best performers because Dollar Tree, companies where Dollar Tree, Dollar General, companies that specialize in lower cost goods tend to do well in recessions because people are cutting their costs. So it's starting to go on an uptrend here. Let's go to T-Mobile. They are kicking the butt of AT&T and Verizon. They're taking market share and they're growing at 30%. And Verizon and AT&T have the opposite chart. They're going down. So this company is not paying a dividend, T-Mobile, but they have a deal with Starlink. They have better service in emergency situations, and I think they're gaining momentum. And the dividend for AT&T and Verizon could be at risk, or their stock prices. Waste management is doing good because people use trash in good times and in bad. And the CEO of the trash companies are saying that there is strong demand and they have high visibility. Whenever your company says they have high visibility, that's a good indication that it's a robust company that will be good in this environment. And it's really hard to get into this field and this type of business because they don't get permits easily. You got to build certain facilities that cost a lot, and you got to get permits for it, and all those permits have been given, and they're not giving out new ones. So Waste Management and Republic Services are both like a duopoly. So, and they're buying up a lot of these smaller ones, so there's not too much competition. All right, so and they pay a dividend. So another little article that says Jamie Dimon calls crypto tokens decentralized Ponzi schemes. So he's been on and off with this. He allows his customers to trade in crypto, but he said it was a fraud 2 years ago, and he's on and off. But he just said to Congress that crypto has no value. It takes a lot of money away from hardworking people through heists, people stealing their money, and there's a lot of bad actors using this for illicit purposes. So he doesn't like the crypto. Hopefully, there's going to be some way to protect investors. Right now, it's just the lessons learned are you can't commit any large amounts of money to this because it's a scam and it's not an investment. And I'd say just stay away from this. I've never invested in this. I think if you made any money in it, take it and run and put it in something stable, like a something like we're talking about. But if the market sells off, people are saying, oh, there's some kind of value in like gold and crypto, but in reality, all risk assets will plummet when the stock market sells off. So if the stock market goes down, limit down every day for the next week, the price of Bitcoin is going to go down with it. There's no value in that. So, just saying. Okay, we already talked about this. And there's a lot of companies like Goldman Sachs and Bank of America. They're cutting their target for S&P. And that's basically saying we're not going to go anywhere for the next couple months. And that's due to, you see, so Goldman says it'll end the year where it is right now, basically. So we have to keep these in mind. The estimates for the S&P are very important because that'll drive every other stock. Because every stock follows the S&P, basically. Here's an article about Eli Lilly. We've been talking about this stock for a while. It's more of a Eli Lilly's kind of a conservative company that sells drugs, and they have the drug for diabetes. They're repurposing for obesity, and this one company said that drug Mounjaro has shown promise in a weight loss treatment. So just think of this could be one of the best drugs of all time, the analyst said. But it's gone up a little bit on this news, but in a bad market, this company's going to sell off. So we got to keep all these things in mind. We're doing our research here, and we have to see. They also have an Alzheimer's drug. If that's one of the most unmet needs in the world for treating Alzheimer's patients and potential Alzheimer's. So Jim Cramer really likes this company, and he's been pounding the table on this for months now. So we'll watch this stock as it goes down in like a pandemic or whatever kind of crash we have next. And what we know that it could have one of the best blockbuster drugs around. And we'll look at the next thing we're going to look at is Eli Lilly's earnings estimates. You can see from this is E-Trade. We have earnings estimate chart from E-Trade. This is consensus estimates. We see they're going to be growing at 15% on average for the next couple of years. Their PE right now is 32, and they're growing at 15%. So that's like 1.84 times overvalued. But in a bad market, it sells off. It's going to be trading closer toward its growth rate. It's paying a 1.32 yield. So I want to watch this go down and crash and dollar cost into it. Because I think it's I trust Jim Cramer, and his analysis, and the numbers look good so far. And you can see from this is Yahoo Finance, its PEG ratio is 1.79. That kind of matches our calculation. And the numbers for profit margin and return on assets equity are good. So, there's an article about Ford stocks sinking on inflation supply constraints, warning. So they did confirm that they're still going to be earning, what they're going to meet their estimates for next year. So that was the big thing that I noticed. But they're constrained. They have a lot of 35,000 cars that need things before they can sell them. So they're making a lot of cars, but they can't sell them because they're still waiting for the plastic Ford symbol for the back of the car or something like that. So that's going to cost, and then they have higher input costs. So they're going. So this is just another canary in the coal mine. What happens? This is probably going to happen to all the other car companies too. They're all going to have similar problems. All right, so we can see from Morningstar, they haven't changed their fair value estimate. Their main highlight in their research is supply chains bad, but full year guidance still intact. So that was the big That was a big thing I came up with from this. It went down 10% one day this week. But this is a short-term thing. This should resolve itself by mid next year at the latest. Let's see. And CFRA says the fair value is around 33, which is almost double where it's at now. Okay, so let's look at our investor emotions sentiment chart. Okay, so you can't get any worse in sentiment than right now. People are afraid of this. They're seeing prices go up everywhere. They see the stock market going down. Put that combination together. People have less to spend. They're borrowing more, and that leads to despair. And that's like the total opposite. That's the perfect time for starting to get into the stock market when everyone's selling out and afraid. So it's just whenever the weak hands are forced out of the market. People can't hold it anymore. I don't want to lose money. I might lose all my retirement. It's just that time when we make this end of the year rally and everything's back to normal. So it's just one of those things you have to go through as a long-term investor. I've been through this kind of thing 4 times since 2008 when I started investing. So it's just a rite of passage for people in the stock market. Everyone knows that these bad times come, and you have to believe in the long-term story of your stock and that they're executing with their plan. Only if it's temporarily, they might have to not make money for a year or 2. Okay, we talked about this being the worst months of the year for stocks on average for the last 20 years, 40 years. And then we're going to look forward to November and December. Okay, so let's look at finance. Yahoo Finance is one of the best places for articles about companies and the stock market in general. That gives you the current S&P, Dow, NASDAQ, and Russell charts, and it gives you good articles about what's happening in the stock market, the most important things. We got to look at some of the articles. So, stocks are sinking, rates are rising. It's painful, we're heading to normal. Okay, so right now, normal will be whenever the Fed says we're at a neutral rate, we're not raising anymore when that happens, and the stock market will stop going down basically, and we'll be at an interest rate that's more reasonable, and probably mid next year we're going to be out of all this. So let's look at okay. There's a billionaire Carl Icahn warns the worst is yet to come for investors, and compares U.S. inflation to the fall of the Roman Empire. So he says sometimes there are big investors like Carl Icahn that they talk their book. If he's trying to get the market scared so that it goes down, he would bet against the market before he says something like this. So you have to. He's pretty smart. Carl Icahn does a lot of agitation in companies to make them more efficient, and he's really good at that. But he picks a lot of fights. Like he would pick a fight with McDonald's for how they treat their animals, and he does that with different industries. He picks fights. Carl Icahn picks fights with oil companies because they're not managing their money well. They're spending too much money or something, and I can't keep up with all of his little fights with companies. But his point in doing this agitation, and he takes a 10% position in a company, tries to change the management to be more efficient, then he sells out and does it with another company. So yeah, this is what I was saying earlier. Jeremy Siegel accuses the Fed of raising rates too much. He says that the Fed is raising rates a lot now, and as the price of commodities are going down exponentially, like the price of gas is going down, wood, all these things that were now, he thinks they're going to raise them so much that the market's going to crash and the economy is not going to, it's going to seriously crash. So he's pretty smart. He's I think Harvard professor. Let me see. So, let me see. Kathy Woods, we talked about her last year. She's saying it's time to buy in the dip. She's been saying that every week since her funds started going down. But the reality is she puts her money into things that are super overinvested without earnings. And they're the worst things to own right now. She's like trying to be a cheerleader for her fund. But the reality is, in an environment like this, people don't want to buy companies that have earnings 10 years from now. She has these mystical assumptions that this company's going to have a market of $10 billion in 10 years, but will that ever happen? And we were saying, that's really risky last year and stay away from this, and it went down 80%. So she's going to continue to cheerlead her fund, but in reality, no one knows until 10 years from now when these things either work or don't. But you don't want to commit a whole lot of your money into one of her funds because they're pretty risky. And let me see. What other good stories can we see? Okay, there's a lot of companies right now, like Google. Facebook is another company. They're starting to cut costs in a major way. They're firing people. And Google, they've had this history of offering amazing perks that are their employees. Now they're pulling back on those perks because they gotta meet their numbers, and almost every company is trying to conserve and cut costs whenever they can, and that could push employees to the point where they're upset, and that's what's happening with Google right now. So I guess in recessionary times, so here, look at this. Google has another heated all-hands grilling over spending cuts. So they're facing pressures, and that could be an indication that Google's going to have a hard time with earnings if they're pressuring their people to cut back in expenses. See, these are little canaries in the coal mine. You got to put them all together to make an estimate of, how it's going to affect the stock or what you're watching, or like stocks. Like this could affect Facebook. It could affect other stocks in the same business. So AT&T approaches key support as dividend yields 7%. AT&T has been crushed this year. It's down 40% from its high. That's because T-Mobile is taking their business, and they don't have as good 5G network as T-Mobile, and so what we can read from that is they have to offer more to customers to get them to sign up for them. So they're going to be giving away iPhone 14s as a subsidy, and that's going to help Apple. And there's a huge fight between these companies. You can see it on the ads on TV that they're giving away devices in order to attract customers. So I don't know what percentage it is of Apple's total sales, but that really helps Apple. Let me see. Okay, so Jerome Powell says that the housing market needs a difficult correction so that the folks can afford homes again. But you can translate that as, you can translate this into he's going to raise rates a lot, and that'll make the cost of mortgages go up per month because the rates, mortgage rates will go up. That'll make the demand for housing to go down, and that'll make the price of the house go down. That's bad for the stock market. That's how we translate that. And let me see. Okay, this guy Michael Saylor, he says Bitcoin is going to whatever the number is. He risked everything in his company. He runs a company, MicroStrategy, and he basically put all the company's funds into Bitcoin, and he started borrowing money to buy Bitcoin. And whenever Bitcoin price went down, it tanked. So this MicroStrategy is like one of the most it's one of the riskiest stocks. I mean, I'm surprised they allowed him to do this. It's very irresponsible, but he's basically risking the whole company and mortgaging and borrowing money to buy Bitcoin, and that has a very good chance of going to zero if Bitcoin goes down. So he has high hopes of this Bitcoin going up, but they stay away from that. All right. So that was a good, interesting article-looking session. All right. Well, I think I've reached my capacity for today. If I could answer any questions for you during the week, let me know. In the meantime, have a good weekend, and I'll see you all next time.